There are very few credible resources available which provide information regarding the timing of the stock market. The reason for this information deficit is primarily because it is a very difficult task to accomplish, and therefore most people who have enough intelligence to recognize the limits of their own capabilities are afraid to attempt it because they worry that they might be wrong, and that this could result in legal troubles if someone were to follow said advice and then claim damages, not to mention the effect that it could have on their reputation. These limitations and hurdles should not, however, be permitted to stifle all logical dialogue pertaining to this topic. Unfortunately, those who are well informed tend to treat this topic as taboo, since they likely have a great deal of concern for their reputation. If an opinion, however, is based on a calculated, logical, and rational methodology, there is no need for this concern, since as any scientist will say, there is never any harm in making an educated estimation or hypothesis about how this complex world works. Market fluctuations, in my opinion, are exacerbated by a pervasive lack of knowledge on this issue, which is caused by a severe lack of constructive and meaningful dialogue. This ignorance does more harm than good, and so the topic should be discussed more frequently, more openly, and without so much hesitation on the part of intellectuals in the mainstream forums of discussion. Currently, this topic is all too often relegated to the fringes of the media, where the dialogue tends to be dominated by people with very loud, extreme, and unnecessarily alarmist or incendiary opinions, which often straddle the boundaries between the absurd and run-of-the-mill conspiracy theory. With no regard for the potential harm that this type of infotainment can bring to the viewers, these fringe opinions constantly drown out reasonable fact-based information, and this brand of dialogue unfortunately tends to turn away the vast majority of stakeholders who are eventually going to be affected by the volatility in the stock market. It is my genuine intention that this video can counteract this trend by tossing in a bit of knowledge and stimulating some meaningful discussion. Of course, there is never a guarantee that historical trends will accurately predict the future, and it is important to remember that it is technically impossible to time the market. That being said, the data in this video demonstrates a trend that has been noted to predict the past 7 recessions since the 1960s. The reason why this information can be particularly relevant is because it coincides with Keynesian macroeconomic theory, which is the foundation behind the mandate of central banks in the developed world. As well, the central bank is very predictable with its message and with its actions that their expectations of the unemployment rate is the key driver behind their interest rate adjustments. By their very nature and by their design, these adjustments reset the economic cycle when there is a sharp decrease in the unemployment rate, which would lead to inflationary pressure if no intervention were to be made. Observers often accuse the central bank of manipulating the markets. However, the data makes it clear that the central bank is indeed focused on the inflation and the unemployment rates. It is very frequently communicated to the markets in a clear and consistent manner that the primary mandate of the central banks, which is issued by the governments of all developed nations, is to avoid inflation, and so this is the main driving force behind their actions. This video first explains 2 indicators, which can act as a canary in the coal mine. Using these indicators, the data can then be interpolated backwards through the decades using publicly available data from 2 US government websites, which have been found to provide consistent indications of an upcoming major stock market correction, as well as a forewarning of an imminent bull run. Without further ado, these key indicators are as follows. The yield curve. As can be seen in the data that is provided by the U.S. Department of the Treasury, the yield curve tends to change its form over the course of each economic cycle based on the outlook of the future interest rates at any given point in time. 2S10S. The Federal Reserve Economic Data, FRED, from the St. Louis Fed includes, among other data, the spread between the 2-year yield and the 10-year yield, also known as 2S10S. Similar to the yield curve, this spread changes with the interest rate adjustments. It tends to go negative and then rise sharply before a stock market correction. After it peaks just below 3, and as it falls, there is usually a bull run, which lasts until this spread approaches 0 once again. The reason why these indicators make sense is because under normal market circumstances, short-term interest rates are lower than long-term rates, which is a reflection of the time value of money. The central bank is unable to directly alter long-term rates, and so it is limited to its ability to adjust only the short-term rates. In a nutshell, as the economy expands, unemployment falls, and this puts upward pressure on wages, which is a key component of inflation. Since the central bank and Federal Reserve both have a government mandate to minimize inflation, they intervene in the economy by raising the short-term interest rates or overnight lending rate. This reflects a higher value placed on money, which, just like anything else, has a price in and of itself. These two indicators are basically two sides of the same coin, since they are both directly driven by short-term and long-term interest rates. The difference is that the yield curve includes a visualization of the range in between the 2-year and 10-year rates. The left side of the yield curve lifts up with every increase to the short-term interest rate until it no longer has an upward slope. After it flattens, it tends to very briefly tip in the opposite direction, slightly downward, which is often referred to as an inverted yield curve. This reflects a situation where the short-term interest rates are higher than the long-term rates, which is not consistent with the time value of money. Meanwhile, from the perspective of the other key indicating metric, the 2s10s dips lower as the short-term interest rate rises. When the yield curve flattens, the 2s10s reaches 0, and then it briefly dips slightly below 0, which indicates that the yield curve has inverted. The stock market usually corrects approximately 6 to 18 months after this occurs. And then when the curve is reset back to its steeper upward slope, this has been a very strong indicator of an impending bull run, or economic recovery at the very least. The article called The Inverted Yield Curve Guide to Recession by Aaron Hankin provides an excellent explanation of these two indicators. I have visited the U.S. government's website and checked to see if the data supports the assertions that were made in this article, and I have found it to be very accurate. The following are graphical representations of the yield curves from 1990 onward. These graphs are snapshots of the yield curves, which are compared to the 2s10s graph, as well as the S&P 500. The yield curve can be seen to flatten and then briefly invert to a negative slope. Following this pattern, the yield curve then resets to the standard positive slope upward shape, which reflects the time value of money. To clarify, as the left side of the yield curve rises and flattens, this is a warning sign that the curve will soon invert. And when it inverts, it is a warning sign that the central bank is applying the brakes to the economy using monetary policy. This action of rapidly raising interest rates slows down the economy and puts enormous downward pressure on stock prices by design. Meanwhile, when the yield curve has flattened, this means that the 2s10s spread has reached 0. If the short-term rates are expected to be raised in the imminent future, then it is highly likely that the bull run is in its last stages, especially if these adjustments are perceived by the market to be abrupt. The economic cycle can indeed reset before these indicators become evident, or after a long period of time has passed, and that would represent the nature of the risks that are inherent in the stock market. As the saying goes, the market can remain irrational longer than any investor can remain solvent. However, the economic cycle has behaved in this predictable manner more or less since the 1960s, which is ironically the approximate time when the US dollar was taken off of the gold standard. Specifically, the yield curve flattened and inverted in 1989 and 1990. The S&P 500 then topped out in mid-1990, then experienced a correction. Again, the yield curve flattened and inverted in 2000, which was followed by the bursting of the tech bubble, which lasted until 2003. Despite the lowering of interest rates, this bust took a few years to begin to recover. Fast forward to 2007, when the yield curve flattened and then inverted. This precipitated the financial meltdown of 2008, which was again slowly remedied by the lowering of interest rates. And at the time of this video, there is much discussion of whether a stock crash is imminent. For the record, this appears to be unlikely based on these indicators. If interest rates continue to get adjusted at the same rate as in the past few years, then the yield curve will flatten and invert in late 2019 or 2020, approximately. And based on these indicators, the stock market correction would come between 6 to 12 months later. This is only, of course, if these indicators remain applicable. So is it possible to time the market? The answer is maybe. Using these indicators, we have seen that there can be a method to the madness, and that it is possible to make an educated guess. Am I recommending that everyone should buy a bunch of stocks now and in late 2018 and hold them until late 2019? Absolutely not. I only recommend that the viewer perform further due diligence regarding their holdings, as interest rates are continuously raised in this very stale bull market. We should all be asking our portfolio managers some difficult questions regarding how the flattening yield curve might affect our investment portfolios in the coming years, and how this correlates with each of our own unique levels of risk tolerance. Please note that the exact website address from which this data can be found changes over the course of time. However, the latest links can be found in the description below this video. It is worth noting yet again that there is never a guarantee that historical trends will accurately predict the future. It is impossible to time the market. The data in this video only shows a trend that has been noted to predict the past 7 recessions since the 1960s. If you have found this video to be helpful or even slightly interesting, please give this video a thumbs up and leave a comment. Most viewers like the videos they watch, but they don't think their feedback makes a difference. And when this positive feedback is not given, there's a tendency for only negative feedback to make its way to the comments section. Comments are the best feature that YouTube offers. Let's make the most of it.